When it comes to shipping markets in 2026, there is certainly plenty to talk about. And that's what we'll be doing today with the team from Maritime Strategies International. Hi, it's Marcus Hand, editor of Seatrade Maritime News here, with our mid-year Shipping Markets Outlook episode. You'll be hearing from Adam Kent, Daniel Richards, Will Fray, and Tim Smith from MSI, and we'll be discussing the outlook for the second half of 2026 for container shipping, dry bulk shipping, tankers, and shipbuilding. Before we drill down into the specific sectors, we'll be starting with a broad macroeconomic outlook from Adam Kent. Welcome back to the podcast, Adam.
Hi, Marcus, and thank you for having us back yet again.
No, well, thank you so much for taking the time to talk to our listeners. And perhaps you could just set the scene for what has been a somewhat eventful first half of the year.
Yes, of course. We didn't think that the world of shipping could get any more complex. I think 2026 has certainly shown us otherwise up until year to date. The industry has once more been confronted with more geopolitical shocks and a playbook that seems to change almost on a daily basis. But overall, I'd say that certainly from a shipping market's perspective, they've continued to adjust and have performed actually quite well. Of course, a big part of the volatility has been the heightened conflict in the Middle East. And now with the US-Iranian war being a new significant development over 2026, that certainly shaped the economies and the shipping markets yet further. From a pure macroeconomic perspective, our global GDP outlook has weakened since the start of the war, and we've revised this down from 2.8% to 2.4%, with a lot of that 0.4% drop being a downgrade in expected GDP growth actually in the Middle East. I think at the start of the conflict, there was certainly anticipation that the economy would suffer more than it has. But I think that the oil markets have withstood the loss of volumes via the Strait of Hormuz a lot better than most would have anticipated at the end of February. Industrial production remains similar to pre-war levels. And while we've seen some increase in headline inflation by about 1% in the US and Eurozone compared with February, it certainly hasn't exploded like it did 2 or 3 years ago. I think two of the broader drivers that are helping to support the economic resilience continue to be the strength from Chinese exports. And there are a few signs that we've seen that the Iranian war have dented global demand for Chinese goods. And of course, we continue to see the sort of heightened investment tied to AI and all things AI. And that AI investment boom is certainly giving a significant lift to the US, Chinese, Korean, Taiwan economies. Generally in the US, our 2026 GDP growth forecast now sits at around 2.1%. That's a slight downgrade to where we had it at the start of the year by about 0.2%. And that downgrade basically just reflects our view of the gradual drag from the higher energy prices, weaker real income growth, and slower consumer spending. Though the US still remains relatively insulated compared to other advanced economies. Overall, however, we think that the sort of risks do remain on the downside, especially in Europe and East Asia. The picture here is that economies are still expanding, but they've become a lot more fragile. And with the higher energy costs, the disrupted trade routes, and those commodity prices are certainly putting pressures unevenly across these different regions. Our core view certainly remains that the longer term, the longer we see the disruption to oil and gas supplies, the greater the negative impact this will be on the global growth. However, we have sort of become a little bit more optimistic about the world's economy resilience to withstand these geopolitical headwinds, given events that we've seen over the course of the last 5 years and just how well the global economy has performed. If we look at from a more of a shipping perspective, certainly on the earnings side, sectors have continued to perform well, and in some cases exceptionally well in 2026. And this is perhaps somewhat surprising at a headline level if we just look at where we expect global seaborne cargo growth to be this year. We actually expect to see cargo growth at around -1% in 2026. And that's largely due to the lack of volumes going through the Strait of Hormuz given the war in the Middle East. Therefore, the support in the market continues to come from the inefficiencies that we see across the various sectors of shipping, longer ton miles, slower speeds, longer waiting times to get into ports, and general disruption. And we've also pushed back our expected timings to see returns to transits via the Red Sea into 2027. Again, that continues to support market balances. And at the same time, we've recently seen the Panama Canal Authority reduce the number of transits it's expecting through the Panama Canal due to drought conditions. And with this year being a potential severe El Nino year, we could see further reductions in Panama Canal transits, which again would help support market balances for most shipping sectors. On the supply side, ordering continues at a pace. So we're seeing similar volumes being ordered over the course of the last 5 years as we did during the super boom years between 2003 and 2008. Containers ordering has, I guess, passed the mantle over to the oil tankers this year, and oil tankers have certainly taken the lion's share of all orders, while scrapping generally remains at a snail's pace. We've seen virtually no scrapping over the course of this year, counter to the high ordering volumes that we have seen. So I think this time last year, when we did a similar podcast, I did comment on that it's been a very eventful start to 2025, and I think we can say something very similar. And it seems to be a playbook that seems to be playing out pretty much over the course of each of these podcasts that we do, that there are always a series of events, as you sort of said in your introduction, Marcus, that have been shaping the shipping markets and continue to shape the shipping markets as we move forward over the course of 2026 and into 2027.
Thank you, Adam. There's a lot of different things there that are going to affect the individual sectors that we're now going to look at in more detail. If you're enjoying the Sea Trade Maritime podcast, make sure you never miss an episode by subscribing on the app of your choice. First, we shall be turning our attention to the container shipping market with Daniel Richards. Welcome back to the podcast, Daniel.
Hi, Marcus. Good to be back.
Thank you so much for taking the time. Now, container freight markets bounced back in Q2. Could you give an overview of what has happened in the first half of this year?
It's in many respects quite similar to what we saw a few years ago with the initial phases of the sort of Red Sea crisis. So the container market started the year in generally pretty subdued fashion. That obviously was coincident with the liner companies generally returning to being not profitable or only slightly profitable. And that followed on from a relatively weak period for markets at the end of 2025. You did see a bit of an increase in spot freight rates in the run-up to the Lunar New Year in China, but thereafter it seemed that the industry was heading back into a relatively weak period for markets, and that even before supply was expected to ramp up again in 2027 and beyond. Now, in practice, events have conspired to generate a far more profitable market for liner companies, a far more volatile market for beneficial cargo owners and shippers. And the initial catalyst for this was the closure of the Strait of Hormuz. That's clearly not as significant for the container sector as it is for certainly the tanker sector or certainly the gas sectors. But what we saw is, with the rise in global bunker prices, you started to see the imposition of bunker surcharges on top of freight rates. That had an initial inflationary impacts on freight rates. You saw freight rates, certainly to the Middle East, begin to surge as you saw the loss of sailing capacity to the region. But I think it's what's happened since then has been what's kind of caught people off guard a little bit, in that bunker surcharges have been added to freight rates, but those should be measured in sort of hundreds of dollars. But what you've seen is compared to the situation before the war in Iran, Asia-Europe freight rates then were around sort of $2,500 per FEU. Those have gone up to around $5,000 per FEU now. Rates on the Asia to US West Coast trade that don't go anywhere near the Middle East, those vessels at least, those have gone from around $2,000 to $2,500 to above $6,000 per FEU. So it's been a far more explosive response in markets than many would have expected. And there isn't really one single driver. There's evidence clearly that the demand side of the industry is helping. Demand has held up really well so far this year. So again, continuing growth of around 5% year over year. Only really some of the Middle East trades have seen a notable negative impact so far this year. What you've also seen is the vessels have slowed down a bit as a result of the increase in bunker prices. That takes effective capacity out of the market. It's also likely that the loss of access to sort of the transshipment hubs in the UAE, so Jebel Ali and Khalifa, that's possibly having some ripple effects on the wider efficiency of containerized supply chains. And as those become less efficient, that takes supply out of the market. There's also likely on the demand side that there's been some sort of front loading of cargoes. Now, we can't tell how much this is yet. You can't really tell if you're front loading until you've got the subsequent slowdown to prove that things were being brought forward. But it is likely that shippers were bringing goods in ahead of anticipated higher bunker surcharges, certainly those moving on contracts. It's possible that in the US there was some front loading ahead of the tariff regime changing in July, although in practice tariffs haven't really changed much at all from where they were even before the Supreme Court judgment was handed down. What we're also seeing, though, is it's possible that goods are being brought ahead of expected rises to input costs. So if we look at the kind of the containers arriving in the US in Q2, where those return to annual growth after quite a weak period, you've saw a big increase in imports of things like plastic. So it's possible that people are anticipating that with higher energy prices, energy intensive goods, the cost of those are going to go up. So people are trying to front load ahead of that disruption. So it's been a real kind of cocktail of different market drivers, on top, added to which most recently has been high port congestion. So that has sort of spread out from the kind of the South Asian hubs to Southeast Asia, where up to now, where it's really Shanghai that's seeing particularly significant port congestion and port waiting time. So again, it's a pattern where events kind of happen, containerized supply chains get disrupted, and it's just a market that's far more sort of responsive to these kinds of forms of disruption and loss of supply compared to where we were in the pre-pandemic years. And I think that this has been the sort of the third instance of that explosive responsive freight rates to events following the COVID-19 pandemic and then the Red Sea crisis a few years ago.
You mentioned that sort of pattern you've seen in the sort of previous crises. In those cases, the freight rates remained high for quite a significant length of time. Would you see that happening in the second half of this year, or will things start to come off again?
So in recent weeks, there has been some evidence of spot freight rates beginning to weaken, certainly on the Trans-Pacific, the Asia sort of into the West Coast trades. I think for the moment, they're not likely to collapse, perhaps partly simply because the bunker surcharges are going to remain relatively elevated. It seems that for the moment, oil prices are going to remain higher than they were before the Iran war kicked off. And for the moment, we are relatively optimistic about the demand side. It remains to be seen if there has been front loading. But I think a big theme of certainly the analytical reports that we're putting out to clients, a theme we're highlighting in those is that the big sort of demand side driver has been the cost competitiveness of Chinese exporters, the inability of Chinese domestic demand to absorb all the goods that their factories are producing. And that's effectively leading almost to a positive supply shock to kind of the global goods industry or manufactured goods industry. So for the moment, we don't see that dynamic as particularly changing. There are rumblings around protectionism, this idea of a China shock 2.0, where perhaps down the line, economies beyond the US will begin to look at this kind of flood of Chinese exports a bit more negatively. But for the moment, provided the world economy can remain relatively insulated to what's going on in oil markets in the Middle East, then we think the demand side of the industry should continue to perform pretty well, but it will be a slower pace of growth likely than we saw in the first half of the year. We're also, for the moment, at least for the remainder of 2026, the supply side of the industry is going to be relatively manageable. So fleet growth in the first half of the year was around 5% year over year. That's still not nothing, but it's in line with growth in demand. In global container trade growth, again, was around 5% year over year. The second half of 2026, you're going to start to see deliveries ramp up a bit. But overall, it's not going to be yet this expected sort of flood of new capacity, but that will arrive in 2027 and beyond. So we think that freight rates probably have peaked, barring other unforeseen events, but we're not expecting a collapse in the near term.
Okay. And you mentioned there on the supply side, when we were talking 6 months ago, we were talking about the potential for a return to the Red Sea. But in Adam's opening comments there, it sounds like you're now not expecting that to happen, given recent events in Saudi and Yemen.
I mean, actually, what we had even seen prior to the events of the past week or so was actually there had been a bit of a gradual ramp up in liner companies announcing returns to the Red Sea. So CMA CGM have been running some services back through the Red Sea for a while now. What you saw in July is that Maersk announced really 3 kind of changes to their services. So one of their Asia-Europe loops with Hapag-Lloyd, they announced was going back through the Red Sea. They announced that a Middle East, India to US East Coast route was going back through. And similarly, a sort of Middle East, Mediterranean, West Africa service was also going to go back through. Those ships have continued to make those transits. There's a few vessels with their AIS currently turned off who should be making those transits at the moment. I guess we'll see what's happened since the recent Houthi announcements, whether that does continue. But yeah, I think in terms of a wider range of carriers, again, the events of the past week where the Houthis are now talking about replicating the Iran's approach in the Strait of Hormuz, it's unlikely that other carriers are going to be rushing to announce returns. But there had been some movement towards that even since the start of the war in Iran.
Okay, but that will act as a constraint on the supply side. How are things looking if we look at the charter market?
The charter market continues to fare incredibly well. It remains very much a vessel owner's market, not a liner company charterer's market. TC rates have remained broadly at a very, very elevated level since they kind of rose in the first half of 2024. And if anything, they continue to strengthen. So not big changes, not all benchmarks we're tracking at once, but rates do just continue to inch upwards. And it's fundamentally it's a story really of continuity where liner companies still are trying to add ships to their networks, in particular charter market size ships of sort of below 8,000 TEU, and they just don't have many to choose from at the moment. This is, again, a longer term story of MSC and other liner companies buying so many ships out of the market, relatively limited fleet growth in some of those segments. So for the moment, if you're trying to fix a ship out to a liner company, you remain in a very strong bargaining position. And that doesn't seem likely to change at all for the remainder of 2026. To the extent we do see a normalization or a weakening in those markets, that's going to take really some time to play out. So even if we do see a weakening freight rate outlook sooner rather than later, it is likely to remain the case that the charter market and then also second-hand values will respond with more of a lag.
Okay, so pretty good news if you're a tonnage owner and supplier to the market. And just sort of one more thing in terms of the vessels themselves, and that's we've seen this continued ordering of new buildings. When does this actually come back to sort of bite the sector?
So the ordering that's happening now isn't really going to be the problem. I mean, the ships that you've seen around sort of nearly 1.9 million TEU of vessels ordered so far this year, compared to 5 million in last year as a whole. Those ships have shifted towards smaller vessels in generally. But we do think that realistically from 2027, 2028, the wave of ships that we're expecting to see hit the water, those are going to have a negative impact on overall market balances. And I think the ordering you've seen so far this year has been interesting. I think that the volume of orders of smaller to mid-sized ships that we've seen placed has been more than I think people had anticipated. We're seeing a lot of Greek owners kind of move into this space. We're seeing a lot of quite obscure Chinese owners placing orders at yards people hadn't really heard of before. So there is a bit of a rush to kind of get this volume of tonnage on the water. And ultimately, I think if you look at our measures for market balances, so in our sort of online platforms, in our quarterly analytical reports, we're tracking how this evolution of market balances looks for different subsegments of the fleet. And what we're seeing is that this increase in ordering for the smaller to mid-sized ships, it is generally speaking still consistent with the aging profile of that fleet. It's a very different picture for the large ships where there's no elderly fleet to scrap. But I think what we're going to be trying to do for clients in our upcoming reports and model updates is really try to tease out how do you balance this very lopsided order book and fleet profile dynamic, and really how do you find homes for all the large ships that we're coming to see online. And like you saw in 2015-16, is there going to be a point where there's a pinch point in the container ship cascade where the volume of larger ships is too much for smaller trade lanes to absorb? So it's a really interesting picture. On top of this, you have all the dynamics around the energy transition and the potential for liner companies to slow their fleets down. But the big picture is, although the industry clearly is quite responsive to episodes of crisis, and that can lead to sort of temporary kind of boost profitability, the big picture is that the order book is very large at nearly 40% of the fleet now, and we think that will take a toll on markets as we move into next year and beyond.
40% of the fleet, that's a pretty big number. It'll be very interesting to see how that plays out in the years ahead. Thank you, Daniel. I'd like to move on so we can look at the dry bulk market with Will Fray. Will, welcome back to the podcast.
Hi, Marcus. Nice to speak to you again.
Thank you so much for taking the time to talk to our listeners today. Will, dry bulk has enjoyed a strong first half of the year. Could you give an overview of the market and what has happened, please?
Yeah, well, you're right at the very, very start of the year. I think the charter markets had started to soften a little bit, but things have been upended somewhat. And certainly, as the years progressed, then charter markets have strengthened, albeit being highly volatile, with the upsides weighted towards Cape-size ships, really. I think that the Middle East crisis has had obviously a significant impact. It's dampened some minor bulks trade, and we've also seen Panamax supply growth being quite strong. So those factors have undermined the sub-Cape-size earnings, relatively speaking, whereas iron ore and bauxite trade and Cape-size ships has been firm. So the upside really has been tailored more towards those Cape-size ships. Indeed, charter rates of Capes in Q2 were almost as high as they were back in 2021, although sub-Capes are about 50% lower by the same comparison. I think more striking this year has been the rise in the second-hand asset values in bulker markets. We published some analysis in our Horizon Monthly dry bulk report recently to show that an investor with a cost of equity of 10% and an investment horizon of 5 years would struggle to justify buying ships at today's prices purely for the vessel's returns, even on the strength of the current freight futures market, unless they believe it's still further upside for asset prices in future. And we pointed out they'd actually need to sell ships at prices higher than they paid for it in 5 years' time. So there's certainly been a really very high rise in second-hand values, which has been more surprising even given that strong freight market.
What would you say was behind that rise in second-hand values? Are there any sort of factors that you can see in particular?
Well, it is a question because we're looking at the underlying economics of it. Now, obviously, the fleet is aging. There is a sense of owners wanting to secure modern tonnage to replace older ships, and the new build prices are so strong that will be pushing some owners towards modern assets rather than contracting new ships. And in particular, you've got a very long lead time between ordering and delivery. So there's some incentive there for owners with a strong cargo book to be purchasing new ships, but to be frank, there's also been high rises in older asset values as well. So there is some kind of speculative purchasing perhaps, or maybe some more short-term drivers secured to short-term cargoes that are supporting those investments. But from MSI's perspective, looking at the economics of it, looking at the patterns versus historical distributions of values, then what we're seeing is that second-hand values are excessive compared with historical relationships, essentially.
That's interesting to see that happening in the market. You mentioned the way you talked about the rise in rates. It seemed to be much more biased towards the larger sizes of vessels. How much does geopolitics play into that? Because I think the smaller sizes were more impacted by the closure of the Straits of Hormuz, for example.
Yeah, absolutely. Yeah, I think there's, I think the certainly directly in terms of the trade in and out of the Strait of Hormuz, then that is affecting the smaller sizes. But of course, there are indirect effects. So directly you've lost the fertilizers coming out of the region and aggregates trade, and obviously there's some importing of grains and steels. The Middle East accounts for around about 3.5% of global demand. So whilst it doesn't seem like a lot, it is significant in terms of the trade volumes, in terms of market balances. But really, it's the indirect effects that are perhaps having a bigger impact on dry bulk market. Obviously, oil and gas prices have risen, and coal has certainly benefited from this. Increased chartering for coal trade into Far East Asia, into Japan, Korea, and Taiwan. Bunker prices increasing have sort of brought about lower speeds, or at least prevented vessel speeds from rising, even when freight markets have strengthened. But anyway, there's always the sort of more nebulous positive effects of changing trade patterns as charters look to source commodities from alternative origins and the disruptions associated with that. So the effects, whilst it directly are more associated with the kind of sub-Capesize market, and that's been more negative for those vessels, there have been other factors which are more positive and perhaps more positive for the market in general and for that Capesize segment.
Okay. If we look into the second half of the year, what do you see as the demand picture and what's driving that?
Well, I think it's increasingly looking difficult to see a resolution to the Iran conflict in the short term. So these kind of disruptive effects that we've been tracking will continue, particularly for grains, minor bulks trades. The trade into and out of the region certainly won't be smooth, even if the strait is reopened in some form. So that sort of loss of trade is likely to continue for now. If we go through the different commodities, China's steel demand is still weak, so you could argue that there are some downside risks to iron ore trade. But actually, we're assuming that the China's domestic iron ore output will fall, supporting more trade out of Australia, Brazil, and obviously Simandou is now ramping up. And as we go to the second half of the year, you'd expect to see a seasonal bump. So from the iron ore markets, if we could leave aside those downside risks from the China steel market and assume that the domestic iron ore production will come down, then there is some upside there. Bauxite trade is perhaps a bit more difficult to pick. I think there's obviously subject to government policy in Guinea, and they're making efforts to restrain exports. It might take some time for that to come through. They're looking for more investment in alumina capacity in Guinea. So I think we'd say it remains firm, but there are some downside risks if the government takes more extreme efforts to reduce that trade. For coal and for grains, we're probably expecting to see some more disruption related to El Nino. For the dry bulk sector, then we probably expect to see stronger power demand in Northeast Asia and lower hydropower output. So overall in that region, you expect a boost to coal demand and coal trade. Grains markets are a bit more difficult to call. You probably see lower trade out of Australia. The impacts in the Americas are kind of depend on the intensity of weather patterns and timings. Often in the past, we've actually seen that it's had a negative impact on yields in Latin America, but that's probably going to affect next year's trade really rather than this year. So overall, I think for that, then the balance is a bit more positive for coal markets more than offsetting that downside for grains. And then for minor bulks, I mentioned Middle East, but also there is some pressure on steel trade at the moment. There's Europe's CBAM policy is having some impact on European steel imports, and there's also tariffs around the world on China's steel. So I think we're a bit more cautious on the minor bulks market. So overall, I'd say the picture is for steady but not solid growth in aggregate. We're actually predicting around growth in cargo of around 1.5% year on year as a whole. Now that actually, funny enough, is the same as what we predicted 12 months ago, but the composition's changed a lot. So whereas previously we were expecting it to be driven by minor bulks trade this year, actually it's switched into more kind of iron ore and bauxite, much more positive than we were previously, and that helps explain why the Capesize market is being strong. But I think that obviously one of the key impacts from El Nino is the low water levels in the Panama Canal and the restriction of access there. So we, through our market models, we account for these inefficiencies when translating cargo growth into actually the fleet required to move that cargo. So that incorporates not only ton miles effects, but also reroutings, also port delays, speed, and other inefficiencies. So we're actually predicting demand in deadweight terms to rise by 4.5% this year. And actually there's upside risks to that if the access to the Panama Canal is dramatically restricted. So there's quite a big difference between a 1.5% growth in cargo to a 4.5%, maybe 5% growth in the demand for shipping, particularly if the fleet is going to expand by just under 4% this year. So that probably gives some indication then of how much those inefficiencies are affecting the market. Again, that's something that Adam mentioned right at the start of this discussion. Globally, inefficiencies are having such a huge impact on the market, and they continue to do so. So I think in summary, our demand outlook is relatively firm, but not necessarily from trade volumes, more from inefficiencies.
That could make quite a serious difference there, based on what you just described. You mentioned the supply side there. I think you mentioned a figure of 4% growth. How is that looking? And you also talked earlier about the high second-hand prices.
Yeah, so in terms of fleet growth, I mentioned earlier about the Panamax fleet growth dampening sub-Capesize freight markets this year. And that's going to continue to remain quite firm. We're expecting that section of the fleet, the Panamax section, so we were at between 70 and 120,000 deadweight, will expand by over 5% this year. So that is a real kind of strong area for fleet growth this year. I think interestingly, we're about to see an uptick in Capesize ships being delivered. So Capesize market has, again, one of the reasons why it's been strong this year has been a few years cumulatively of low fleet growth. So we had 1.5% in 2025 and 2.5%, but that's rise 2.5% this year, and actually expecting 4% in 2027. So whereas the Panamax market's been growing quite strongly for now and is kind of flattening off at around about 5% and will probably start to decline, Capesize fleet growth is going to start to ramp up. So I don't think that will have an immediate effect on the freight market, but cumulatively, as we head into 2027, then an increasing influx of the Capesize vessels will start to challenge that segment's market balances, albeit if freight rates come off, they're going to come off from a very high base. So it's not predicting disaster per se, but certainly it will start to have a dampening effect on the market.
Thanks, Will. There's a lot of interesting factors to watch there as we go through the rest of this year and into 2027. Now, I'd like to sort of turn to the tanker market and welcome Tim Smith back to the podcast.
Hi, Marcus. Thanks.
Tim, thank you so much for taking the time to talk to our listeners. Now, coming to the tanker sector, that's the one that's probably been the most impacted by the war in Iran and the effective closure of the Strait of Hormuz. Can you explain what this has meant for the tanker markets in the first half of the year?
Yes, I think certainly of the sectors we're covering today, it has been the most affected. I think Dan mentioned as well, gas carriers as well, also significantly impacted. But yeah, tankers, of course, the Strait of Hormuz, the conflict between the US and Iran, and the disruption there has effectively cut off a key route for a large amount of global oil trade, both crude oil and products. And as a consequence, I think at the start of the year when we did this podcast, we were talking about the US Venezuela issue, which was at the time a sizable geopolitical event. Seems quite a long time ago in memory now. This is an order of magnitude greater in terms of its impact on both the tanker market, wider oil markets, and global economy. And as a consequence of this, which really did start towards the end of February, we have seen a massive spike in tanker rates, broadly speaking, primarily impacting segments most exposed to oil movements from the Middle East, but also has rippled across the wider tanker market. We've, of course, seen oil prices move significantly higher, and we've seen knock-on effects on the wider global economy. So it's been a huge event, certainly for tanker markets, but of course more broadly, and it's very much dominating the wider geopolitical environment this year. The reason we've seen that, I think the key or a key point for the tanker sector is the sort of divergence between the earnings picture, where we've seen very strong rises, certainly in terms of nominal rates from the Middle East Gulf, which haven't always been widely accessible, of course, because of the disruption to the Strait of Hormuz. But the cargo side has dropped significantly as we've seen oil effectively hemmed into the Middle East Gulf, unable to move out. One key offset for that has been the fact that crude oil has been able to be rerouted, both largely across Saudi Arabia on the East-West pipeline to the Red Sea, but also by the UAE as well, via their pipelines as well. So we've seen a significant volume of crude, around 5 million barrels per day, additionally moved through alternative outlets. And I think that's had a very important effect in terms of cushioning some of the impact on the wider oil supply chain, if you like, and oil prices, although they've moved very high, haven't moved perhaps as high as people might have expected when this event was being speculated about previously. For the tanker sector, earnings have stayed very strong, and of course we've seen a lot of fluctuation in terms of the situation itself. So it's been a case of weekly, even daily tracking, and of course everyone else has been seeing what's happening in terms of the potential for the peace talks, the memorandum of understanding between US and Iran in June. That's broken down into July, so we've seen a resumption in tension, conflict, and uncertainty around whether and when the Strait of Hormuz will effectively be open. That's both increased oil prices and also added further fuel to the tanker rates picture. We've seen markets move up again in July. And then on top of that, of course, we've seen potential or actual disruption in the Red Sea, Bab el-Mandeb Strait, with Houthi attacks on shipping there, and also attacks on actual onshore infrastructure. I mentioned the East-West pipeline, which has been key to moving crude out of the Middle East Gulf. That's been attacked recently. And we've also seen further attacks on refining installations in the Red Sea, Saudi ones as well. On top of that, we've seen extensive Ukrainian attacks on shadow fleet vessels elsewhere in the Black Sea region, which has added further impact on wider tanker fleet availability. So really, it's an ongoing, expanding, intensifying geopolitical situation, which is driving up tanker rates. And tankers, of course, are kind of part of the wider energy logistics chain. And as such, you tend to see premiums on earnings in the sector when we see these geopolitical shocks. And at the moment, we're seeing intensive geopolitical shocks which are widening. So we continue to see a market which is extremely strong in terms of earnings in the tanker sector.
Yeah, we've seen very sort of volatile rates, haven't we, over the last few months. If you look forward, given all those different factors you just talked about there, what does MSI see as the outlook in the remaining 5 months of the year?
Yeah, so your listeners will find our views on this in our monthly and quarterly market reports, where we can also posit different scenarios. And of course, we have to be fairly flexible in terms of being able to look at different conditional events which may happen, and our outlook is conditional on expectations for these geopolitical events. And certainly with the tanker sector, we've had to factor in more and more geopolitical upside and additional support beyond just those fundamentals I mentioned, which would, in any other situation where we saw cargo demand falling, imply a drop in earnings. I think our expectation going forward is that should we see effectively stability in terms of the effective blockage of the Strait of Hormuz continue for a significant period of time, I would expect to see earnings coming off as a consequence of that drought in cargo effectively. And I think that uncertainty, urgency premium in the market would dissipate to a degree, because of the world will effectively become acclimatized to this kind of new normal of lower cargo, higher oil prices, and you see a drop in earnings as a consequence. Interestingly, in June, when we started to see traffic increase through the Strait of Hormuz in that brief period of recovery, if you like, we also saw tanker markets drifting lower. So similarly, if we start to see a smooth return, and again, that kind of certainty in the market returning, i.e. that we're seeing some sort of picture which is stable, be it blockade or be it increase in cargo, we'll also probably see some of that risk premium coming out of the market, even though we're seeing higher cargo volumes as a consequence of that normalization. So our overall view is that markets will move lower in the second half should we see stability. But I think that's the key thing. If we don't see that stability, if we continue to see this kind of fluctuation, volatility in the wider picture and the relationship between the US and Iran, we'll continue to see uncertainty, and that will continue to drive high earnings in the tanker sector. And as I said, we cover this in our monthly market reports. The other benefit we've had is from our Seascape platform, where you can see effectively real-time shipping, not just across tankers, but other sectors in terms of vessel locations. And we've been able to use that to effectively track choke point traffic, and also look at other areas of the market, such as deployment and asset values, which, as with the case in dry bulk for tankers, have been extremely strong. And the Strait of Hormuz situation this year has not been the only thing going on. We've seen very aggressive moves into the VLCC market by Sinokor, controlling a large chunk of that sector. And I'm sure we'll move on to as well incredible volumes of ordering, which has already been touched on in the tanker market this year too.
Yes. Just as you said, I mean, there's a lot of external factors obviously impacting the market now. And I was going to ask you about that very thing, the ordering that we've been seeing this year, I think especially in the VLCC sector, and what lies behind that, and what you see as it meaning for the market going forward.
Yeah, and it has been exceptional. The VLCC ordering we've seen in 2026 has smashed through previous annual record levels, even in the first half of the year. So that's been going on as we've seen this disruption. And I think in part, when you look at shipping ordering, you look at the causality of that historically, a key factor is usually strong markets, strong earnings. And so I put that as a kind of number one factor, that we've seen exceptionally strong markets for VLCCs. But all of these wider issues we've discussed on the geopolitical situation add to that. I think owners can see the value in the energy logistics chain looking forward and being involved in that. So I think, and that's obviously become very prominent, not just this year, but as we've seen, as we mentioned at the start of the podcast, increasing ongoing geopolitical risk in the world, the prominence of oil and energy shipping has heightened. So high rates, wider geopolitical disruption, I think, has been a factor. But then when we look at the fleet itself, we also see a large chunk of that fleet above 20 years old. A lot of that in turn has moved into the shadow fleet, not just in VLCCs, but in other markets as well, primarily larger tankers. So I think owners can see the supply side kind of renewal picture supporting investment in the market as well. We've now got around 35% order book to fleet ratio for VLCCs. You've got around 20% of the fleet above 20 years old. So you can see the kind of offset. And certainly that plays into our expectations in the longer term at MSI, where we see supportive conditions for the tanker sector, despite some assumption of downward fluctuation in the nearer term. That supply side picture is supportive, but it can't be indefinitely supportive of new contracting. I think the other key factor that's supporting the market is the fact that the fleet's increasingly segregated as well. And so I've mentioned the shadow fleet, so a portion of the market effectively off limits for conventional charterers and so on, moving Russian and Iranian crude. Obviously, we've had a change in the situation in Venezuela this year. But also, I mentioned the kind of incursion in the VLCC fleet from Sinokor, which has been very aggressive in buying secondhand tonnage and also chartering in tonnage this year, and controls a large chunk of the fleet as well. So this is not a market as it used to be 5-10 years ago, where you effectively see this kind of homogenous capacity picture is segregated, and there's a smaller proportion of that market available for charterers as a consequence. I think that's also playing into the overall supportive environment and very strong environment for contracting, particularly for VLCCs.
Okay, interesting to get all the factors behind that. I think that whole ordering that we're seeing in the tanker market brings us sort of neatly back to the last segment we're going to talk about. That's coming back to Adam to talk about what's happening with new buildings and shipbuilding market. Now, Adam, it's been another bumper 6 months for shipbuilders, and not just for tankers, I don't think. Can you give us an overview of the activity in terms of what's been ordered and where?
Yeah, of course. And I mean, as you rightly say, it's been another exceptional first half of the year for ordering, with contracts, I think, in the first half of this year, probably up over 50% versus where it was this time last year. So volumes continue to increase almost year on year. And China, once more, has taken the lion's share of these orders, capturing around 3/4 of all contracts placed so far in 2026. China itself has taken more orders this year than it has done in any other year previously. So we can certainly see that China is continuing to dominate the shipbuilding market. As a comparison, South Korea has only attracted around just under 20% of all orders in 2026. So it's a long way behind China currently. In terms of what's being ordered, it has been a broad mix, as you've heard from my colleagues who've all talked about ordering in their respective sectors. We have seen strong ordering from dry bulk containers, oil tankers, and in the gas carrier sectors. But as we've heard from Tim, I think the oil tanker sector has been the sector that stood out, very much driven by the sort of dynamics that Tim has spoken about in terms of the market segregation, but also earnings. We always see very strong earnings tend to lead towards very strong contracting, and we've seen that once more in the oil tanker sector. And if you sort of class oil tankers with chemical tankers and you look at tankers as a whole, tankers have been responsible for around 50% of all orders placed over the course of 2026 so far. Having said that, containers are still making up a very large chunk of new orders, and as Dan has already mentioned, the container order book now is around 40% of those vessels on the water. And we see sort of move towards some smaller vessels, but we're still seeing some very large orders being placed by both non-operating owners and the liner companies. We have seen new orders outpace new deliveries this year, and that again has continued to push up yard forward cover and have kept new building prices high. We haven't actually seen new building prices, interestingly enough, although the new orders have been coming in, new building prices seem to have sort of found a high plateau at the minute. we've not really seen those new building prices change across any sector over the course of Q2 2026 and into Q3. So that's sort of an interesting dynamic, and one that we continue to monitor in our shipbuilding products to see actually will prices continue to climb, or have we hit a peak, and will we start seeing some declines in new building prices as we move forward to the back end of this year and into 2027.
That's interesting, actually. You would expect the prices to have continued rising, really, wouldn't you? With the amount of ordering we're still seeing this demand there. What sort of lead times are owners looking at now if they're ordering today? And are they going to smaller yards that people have never really heard of?
Yeah, I mean, it is the case that lead times are continuing to stretch out. And if you're ordering a vessel today, you're most likely to be looking at a delivery slot in 2029 or beyond. Certainly orders now being placed for 2030 and 2031. I think you could probably still squeeze some vessels into 2028, certainly the second half of 2028, but that will very much depend on the price you're willing to pay, your relationship with the shipyard, and the vessel that you're looking to place an order for. So I do expect to see some more 2028 deliveries being recorded at the back end of this year. I think, as you say, off the back of the strength in the shipbuilding market, I think we'll continue to see more new greenfield and more mothballed yards coming back to being reactivated. And we are in the situation once more, as we were back in the period 2005 to 2008, where yards are being built and are taking orders for ships before the ship yard itself has been built. And there we're starting to see some earlier delivery slots, certainly some slots in 2028 that are being made available by these new yards. For example, we recently saw the old Gunsan shipyard that used to be HHI in Korea. That's recently come back to fruition, is now taking orders for 2028. The last time that yard made a delivery historically was in 2017. So we're certainly seeing some further expansion of shipyard capacity, both through greenfield yards and the reactivation of mothballed yards. And I guess there is a cautionary note to be made, again, versus what we saw in that period 2005 to 2008, when, again, we saw lead time stretching out 3, 4, 5 years. As we know, the world will be a very different place in 4 years' time than it is today, when a lot of these vessels hit the water, as it was when people were ordering in 2008 and getting vessels in 2012, when the world had moved on considerably over that 4 years gap.
I think that's a very pertinent word of caution there. In terms of if you look at, say, the Japanese and Korean yards, and you mentioned the sort of share they have there, does this boom in ordering, does that sort of bolster their position going forward?
As we said, China is dominating, and almost all the sort of significant capacity growth in shipbuilding has come from China. I think the Japanese and the Koreans certainly have to sort of carve out sort of distinct niches within shipbuilding rather than compete head on for volume with the Chinese shipbuilding community. I think Korea certainly seems to have given up that sort of low-cost, high-volume end of the market and is more concentrating on the high-end, high-value sectors such as LNG, which it continues to dominate, though the Chinese yards are trying to muscle in a lot more on market share there. That seems to be working for the Koreans at the minute. I mean, if we look at the profitability of the Korean shipyards, those that publish their accounts, they had an exceptional year in 2025, the best year they've had for a number of decades. I think Korea is also putting a bit more focus on devoting capacity and resources to military and naval shipbuilding. That is, of course, very high-ticket vessel types, and has attracted a lot of investment for one reason or another over the course of the last couple of years. I think generally Japan is just struggling to capture orders, let alone expand. And we've seen some consolidation in Japanese shipbuilding. We've seen some modernization of shipyards. and we've seen some closing of some of the older facilities. So I think that, the story for both the Japanese and the Koreans going forward, I think, is less about trying to compete head on with the Chinese in terms of volume and defending either their high value or their highly reliable segments, which is has always been the sort of mantra of the Japanese, very good at building specific vessel types on a production line basis. And of course, they are also trying to deploy new technologies, trying to increase efficiencies and productivity to try and compete with China on price. And I think that will be a continual battle between the sort of three big Asian shipbuilders on who can deploy technology, digitalization, sort of automation to try and bring down pricing to remain competitive.
So, yeah, technology becomes a sort of part of that battleground going forward. Now, just to wrap this episode up, what do you see as the outlook for the second half of the year or the remaining 5 months?
I think it's been amazing. As we've sort of said throughout the podcast, we've seen this general uncertainty with regulations, sort of geopolitics, alongside high new building prices. And what we've seen is sort of record ordering over the course of the first half of 2026. The order book now is equivalent to around 20% of the fleet. I think generally we think contracting momentum is likely to continue for the rest of this year, but perhaps not quite at the same volumes as we've seen in the first half of the year. And we do expect to see a slowdown as we move into 2027. They're just, it's difficult to see where that new contracting volume will come from if we look at the individual sectors and subsectors and what has already been ordered. Deliveries will continue to ramp up over the course of the second half of this year, but they won't actually peak until 2028. And I think it's quite pertinent to sort of look at that statistic. 2028 deliveries from our shipbuilding model, we're anticipating to be 65% higher in 2028 than they were in 2025. So there's a huge deluge of new tonnage hitting the water over the course of the next 18 months or so that the industry will have to absorb. Of course, we do expect to see more scrapping. There will be increased demand from a cargo perspective and no doubt further inefficiencies, but there still is a lot of tonnage that the industry does have to deal with over the course of the next few years.
Thank you, Adam. And that's quite a sobering thought, that amount of deliveries in 2028, given how difficult it is to predict what's even going to happen in the next 6 months. So we'll be following all these markets on seatrade-maritime.com, and I'd like to thank Adam, Daniel, Will and Tim for their valuable insights today.
Thanks very much, Marcus. Always a pleasure.
And we look forward to returning to talk about the markets with the team at MSI at the beginning of 2027.